Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you how to transfer a TSP or why it might be necessary to transfer your thrift savings plan into an IRA contract. And I want to explain to you what a thrift savings plan is versus what an IRA is, some problems if individuals leave their monies with the TSP, different solutions that an IRA, when you customize an IRA contract, how that might be able to suffice your specific goals. So to get started, a thrift savings plan is a type of qualified retirement account that's established through a federal agency. So if you're working as a federal employee, rather than a private employee that might be offered a 401k account, which is just a qualified retirement plan, employer-sponsored qualified retirement plan through a private institution, a federal institution has something known as a TSP, a thrift savings plan. So when an individual is working for that federal agency, they are going to be receiving their employee benefits package, and it's going to say, okay, this might be your life insurance, your disability insurance, your health insurance, and then also you could put a portion of your salary into a type of retirement bucket, into a type of retirement account known as that thrift savings plan. So an individual is working, they're receiving income to the individual, and this individual could take a portion of that income and place it over and kind of think of this like a retirement bucket. So the more dollars that this individual is placing into that bucket should be growing that bucket. The federal agency might also be offering a match, meaning that if this person's making $100,000 and the agency is matching 2%, and this person goes and throws $2,000 into this plan, well, then the federal agency is also throwing $2,000. Now, $4,000 is going into that bucket as a contribution for that year. If, let's say, this person puts in $10,000, but the match is only 2%, well, then there's only going to be $12,000 that's going into that bucket at the end of that, of that year or throughout the course of that year. So the other aspect of a thrift savings plan is not so much just the contributions, like taking your dollars, getting the match, and then just as if you're throwing underneath a mattress. Individuals place dollars into this type of retirement plan to also capture upward stock market like returns. So the second part of this bucket, though, second piece to this bucket, to this puzzle, is the percentage rate that is tied to the different options that they could choose to invest into that will either add an additional positive interest credit in there or a negative interest credit. So with the TSP, you're typically limited with your different funding options. You're going to have a C fund, you're going to have an I fund, a G fund, all these different funds, but they're going to be limited right in between 5 to 10, a little bit higher of options to choose from that you're essentially susceptible to whatever that performance is. So like if someone utilizes a target date fund and they're established that in their TSP and they've been contributing all their monies for all that long time, and then all of a sudden that target date fund goes down because the market went down, well, now it's as if you're taking that bucket and you're slicing it in half, or you're slicing it by a quarter. So this is a very important aspect to understand, because this is the main premise behind when you could go and roll over a TSP into an IRA, you're customizing how this percentage rate of return works, or whether you don't want to have as much risk as what a typical thrift savings plan options may provide you, or if you want to have income streams, how that might work as well. So I hope that makes sense regarding just the basics of what a TSP is. Now, what exactly is an IRA? And an IRA, rather than a qualified employer-sponsored retirement plan, this is a qualified retirement account that is set up on an individual basis. So it's something that could keep your monies in that tax deferred status. With the thrift savings plan, if you're into a traditional thrift savings plan, the amount of dollars that you're contributing, the amount of money that's also growing by the different options that you're choosing, all that money is growing tax deferred. So when somebody goes and they have access to pull monies from their TSP, they can either take all their money out, throw it into their checking account, which is known as a non-qualified account, and they'd have to get paid, they have to pay all the taxes on whatever that transfer was. Or what they can do is roll it over into another qualified retirement account bucket to remain among that tax deferred status. So now what you're doing with these types of plans when you conduct a rollover into an IRA is individuals don't necessarily keep contributing into that IRA account. They just want to really hone in on that percentage rate of return. If they are looking to have a favorable growth strategy and favorable growth within their account, well, what's going to be better? Something that has passive investments that only 5 to 10 options, or something that allows an individual to have upwards of 5,000 different options to choose from. Something that could be cheaper, something that has higher quality that will increase the likelihood of having a better rate of return on that overall bucket of money. So it just gives you more eggs in your basket to choose from. And with the IRA, you could customize this in a whole plethora of different options that pertain to your exact goal, whether that's a retirement income goal or a consistent growth goal or an aggressive growth goal or even an inheritance maximization goal. Those things are you're essentially limited to how the funds perform on the TIFs, on the thrift savings plan on the TSP. With the IRA, you could actually segment that more and utilize things known as arbitraging strategies to leverage one sort of product line, one sort of IRA account to therefore give you more benefits in another aspect. And the problems with the thrift savings plan, like I mentioned before, are the limited funding options. If you only have 5 to 10, 5 to 12 different funds to choose from, what's to say that those are going to be the best possible, highest quality funds out there that an individual can choose? And typically, if these funds are inexpensive, and that's kind of the selling point with the TSP, is they're saying, oh, well, they're very inexpensive funds. The caveat to that is you are getting what you pay for. So like individuals that walked into 2008 and thought that their accounts were doing really well with their thrift savings plan, and then they realized that was nothing more than just a passive strategy. Yes, it was inexpensive funding options, but when the market went down, there was no safety, there was no proper diversification in those types of plans, so therefore their TSP plans had average losses of anywhere from 30% to as high as 60% in that 2008 alone. So if somebody had $500,000 walking into the year into their thrift savings plan, they're thinking, oh, great, I'm going to be able to retire soon. And then they walk out of the year with $200,000, $300,000. That's a game changer. That's something that now you have to do a lifestyle change. And that's something that you can avoid when you go and you establish that into a specifically designed IRA contract. When it comes to individual goals, and let's say that person wants to leave their monies in that thrift savings plan because they felt comfortable, they've been doing that for the last 20 some odd years, but they have a goal of income maximization, understand that they're susceptible to a reverse dollar cost averaging effect of paying TSP related fees, which are not high. You have different mutual fund related fees or the options that you choose within that TSP account. So those different funding options have their own fees. Most importantly, downward market loss potential. You're pulling income from those accounts. You have inflationary risk. You have longevity risk, meaning that you could outlive those monies. Inflationary risk, meaning that the cost of goods and services should be increasing as you're chugging through your retirement. So all these different negatives are still staying very apparent in your TSP. In order to counteract that reverse dollar cost averaging is trying to get really good, consistent rates of return, so that if you're saying I'm going to pull out 4% per year, well, if you're in something that's more passive of a investment strategy to say, okay, I'm just going to kind of let it ride, I'm going to pull out 4% per year, and if the market goes up, great, then I could sustain that 4%, but the market goes down, well, you're pulling out that income, you're receiving that downward market losses, you're still paying fees within that account, and then you have all these other variables that are working against you. So against an income goal, that could really blow up in somebody's face. If let's say you're looking for a consistent growth goal, so just something that says, I don't want to really risk my money in the market. Yes, you could go and you place your dollars in a G fund and just kind of let your monies ride out there. But what happens is you lose to that inflationary protection. So if the G fund's only paying a couple of percent, but inflation is increasing by 3-4% per year, well, then it's just as that same theory of why an individual does not take their money and just leave it underneath a mattress and then try to pull their monies that way. So there's different ways on how you can diversify if you want to have more of a conservative growth goal, something that allows you to gain when the market goes up, does not lose when the market goes down, different indexing strategies. You could establish those with IRA related contracts. let's say if you're looking for a max growth goal, that you're saying I'm a couple years behind, I want to really put the pedal to the metal. Well, there's certain mechanisms, there's certain things that you could do outside of the TSP, rather than limited to the 5 to 10, 5 to 12 different options to choose from, that you might have only a couple of aggressive growth strategies in there. When you go on the IRA chassis or the IRA side, well, there's thousands of different combinations that you could have much higher quality that would allow you to receive that nice rate of return and increase your bucket size if that growth goal was one of those most important aspects. And then the very last one is a maximized inheritance. With the thrift savings plan, you're subject to whatever that performance does. The good thing about the thrift savings plan is it's going to be very inexpensive. The bad thing about it is you're just susceptible to whatever those measly funds are. And because they're so inexpensive, usually you have crappy funds that are within there. So if someone's really trying to say, okay, I have Social Security income, I have pension income coming to me, and that's enough to suffice my goals, I really want to max out what sort of death benefit is left to my heirs. Well, you just have that one solution to just stay put in that TSP. There's no true max death benefit option available. So let me show you a couple of different ways, a couple of different examples of how an IRA, a specifically designed IRA contracts, can work with just a regular example that an individual might not have been accustomed to and might not have been aware of. And for this hypothetical example, we're just going to say that we have an individual that's age 60. They have $500,000 in their thrift savings plan. They want to retire at age 65, and at that point in time, they're going to be receiving Social Security income of $30,000. They're going to be receiving pension income of $20,000, but they need $60,000 of income at that age 65. So we understand that their need is $60,000. They have a $500,000 bucket, and they're going to be receiving income sources of $50,000. So with this example, we're going to try to tackle this individual's income need. We're going to try to tackle this individual's liquidity need, meaning something that their emergency need. We're going to tackle their growth need. And then also we're going to add a death benefit need. Let's say they want to have a maximized inheritance. So their major goal is to say, I want to make sure that all my income, that my $60,000 are covered. They're coming to me each and every year, regardless of whatever's happening with inflation, regardless of however long I live. This is something that I want to be able to leverage this bucket of money and set it up systematically within specifically designed IRA contracts. So with this need, and just like many others that call over to our agency, we always explain to them that there's 3 criteria that somebody that's nearing retirement, gearing up for retirement, 3 things that they want to make sure that they're always covering for pure retirement confidence. The very first thing is they want to make sure that they have ample amount of income sources coming to them and they're hitting their income need. The second one is emergency funds. You might have seen this with some of my other videos. And then the third one is to combat inflation. So with this situation, we have an individual age 60. They want to retire in exactly 5 years, and they have a gap of $10,000 that they need to have come to them. Well, rather than the greedy advisor that's going to tell them, oh, take the $500,000, just put it all into one scenario, what we're saying is, no, we could customize this specific account. If somebody already hit age 60, they could do an in-service withdrawal if they're still working for that federal agency. If they stopped working, then they could do a full withdrawal. And when I say withdrawal, it's not a withdrawal like into your checking account. It's just a rollover into a specifically designed or many specifically designed IRA contracts. So in this example, we understand that the need is for 5 years to produce $10,000 of income, and their major goal was to say, I want to make sure that I can never outlive those monies. So with the Social Security income, that's something they cannot outlive. The pension income, that's something they cannot outlive. And now we could leverage an IRA annuity contract. Not like old-fashioned annuities where you're losing control, and if you passed away, then all that money has to now go back to the insurance company. I'm talking about ones with income riders, ones that are specifically designed for that 5-year time horizon that says, if you place your dollars into this type of contract and you roll over a portion of your TSP into this IRA annuity at age 60, at age 65, based upon our contractual guarantees, we will be able to provide you that $10,000 every single year. We'll break that down monthly every single year to the day that you pass away. So if this person goes and let's say that the results come back and it's going to cost this person $100,000 into the top hybrid annuity contract that will produce them, because you're using an income rider, produce them $10,000 per year to the day that they pass away. If let's say they only live for a couple of years and they pass away, and let's say there's only $80,000 remaining in that person's account value now, well, now $80,000, rather than go back to the insurance company like old-fashioned annuities, that would go directly back to the beneficiaries to make sure that that could now leave that inheritance. So that's a little bit of that death benefit. So all that it took for that specific income goal to suffice what that income gap was $100,000. The second aspect is emergency funds, something that they're not going to be susceptible to just placing their dollars into contracts where they can't automatically pull money from. Something that we could give them that chance to, if that emergency ever happened, if an oh my gosh moment occurred, something that they could always pull from, but is not going to be susceptible to downward market losses. So you're not looking to get growth on this sort of plan, on this step number 2. It's just saying, okay, you want to make sure that you're segmenting in between 6 to 12 months of reserves into something that's completely liquid cash in case of medical emergency, something like that comes up that you could easily pull from those accounts. So that would be, we could call it $50,000, could be established into an IRA money market account. And once again, we're using traditional IRA accounts, because these are already qualified retirement accounts with the TSP. So we're rolling it over into qualified IRA accounts so that the money's able to still grow tax deferred. It's not as if you took all that money out through into your checking account, so you have to pay taxes on it right away. All of these monies are still going to be growing tax deferred, and then you'll get taxed on each time that you're taking a distribution from those monies, because those are pre-tax monies. They're monies that you never paid taxes on yet. So obviously Uncle Sam has to get their monies, has to receive their cut one way or another. So with this sort of plan, now it's starting to look, I know this is very sloppy on the screen, but now it's starting to look more like a perfect puzzle piece. I wanted to clear up some chicken scratch. And what we have over here is the income goal can be sufficed with a $100,000 IRA annuity that's specifically designed. So what we do is we have a Retire Sharp planning system that pulls all this data for us. So we're going to be non-biased towards one company over the next. We want to make sure it's a good rated carrier, but ultimately which one works the best for an individual, either male or female, depending upon that situation, that wants to wait exactly 5 years of growth and to receive $10,000 of annual income for the rest, or break that down monthly income for the rest of their life that they can never outlive. Step 2 was $50,000 went away into emergency fund. So that's just saying that we want to make sure that 6 to 12 months of their expenses are set aside. So this is in an IRA money market account. And then step 3 is inflationary protection. So instead of saying, oh, we have 500,000, let's all throw it into an annuity contract, let's all throw it into a money market account, just slowly siphon off that money. No, you have specific goals in mind. So this tells us that we have $350,000 left over. This portion could be placed with a couple of different options. You could either set up little micro laddering strategies on annuities to say, okay, at age 65, I'm receiving $10,000. Then I want to receive another $2,000 at age 68, another $3,000 of income at age 69, another $5,000 at age 72. So you could set up small micro portions of this and suffice that goal to make sure that you're receiving that income sources. Or you could say, I already sufficed my $60,000 goal. I've already sufficed my emergency fund. Let me put this pedal to the metal. Let me try to be as aggressive as possible with the best possible IRA contracts out there with stocks, bonds, ETFs, mutual funds, much better than those small limited 5 to 10 options that I'm susceptible with my TSP accounts. So maybe out of this $350,000 remaining, this individual takes $250,000 and they want to be super aggressive to say, hey, every year that I keep living, I'll just slowly, systematically pull out a portion of those dollars so that if I have a gain, I'll use that extra money to combat whatever that inflationary need is. And now we have, out of the $250 plus the $50 plus the $100,000, we have $100,000 remaining. One of the other things I mentioned from the very beginning is this person also had a death benefit, maximized inheritance need. So we've already covered our three bases to give that person retirement confidence. This other portion could be established in an arbitrage strategy that this person could place in $100,000, trigger lifetime income streams through insurance-related contracts, and have that lifetime income stream purchase a permanent death benefit. Is known as a GUL plan. It's a type of permanent life insurance. Kind of acts like permanent term, meaning that you're not focused on the cash value with those types of plans, but you're just trying to max out the death benefit. Where you could essentially have $100,000 go into a contract, a retirement insurance contract, that will produce this person $7,000 per year for the rest of their life. That $7,000 would therefore pay for a $300,000 tax-free permanent death benefit. So what we did was we took that $100,000, we put that into a $300,000 tax-free benefit. You have income that's paying for that. So you have a specific contract that's established to say anytime that this income stream comes in, that's what's automatically paying for that life insurance policy. We're using the $500,000. We have some emergency funds. We have the IRA that's going to be liquid cash. We have the annuity that you have to play by the terms of that annuity contract. Some is going to be liquid. Others you're going to have restricted liquidity on it because they're providing you that lifetime income stream. And now, what did we end up doing? Rather than just say, oh, I have $500,000 in a TSP account, I'll worry about that goal at age 65 when it gets there. No, we set up a more systematic puzzle piece to say, our income goal, check. Our emergency goal, check. Our inflationary goal, check. Our growth goal, check. Our conservative growth goal, check. Our death benefit goal, check. And all we're doing is we're leveraging that same dollar amount. And because this person sufficed at age 60, whether they were if they're working for the company, they could do something known as an in-service withdrawal or in-service rollover, and we just designate those out to specifically designed IRA contracts. And you take something that rather than a one-to-one TSP to just a one IRA, you take a TSP to 3, 4, 5 different IRAs that now all serve a customized purpose. So I hope that makes sense. At any point in time, if you found value in this video, please feel free to give us a call, 1-800-566-1002. We are available 24 hours a day, 7 days a week. Simply call in, say that you saw a video online and that you want to speak to a specialist regarding, TSP to IRA transfer in this example. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. I believe it's because of our methodical process. We try to educate individuals first and foremost, and we try to provide them as much value as possible. So we try to educate you guys through literature pieces, personalized videos, just multiple conversations, whatever it takes for you guys to understand and say, okay, I'm currently at point A. I want to get to point B. This is my current situation. Sometimes what you're currently doing will get you there successfully. Other times there might just be slight tweaks that you have to make, such as TSP to IRA rollovers or other combination of things to make sure that you could be as efficient as possible. So, in closing, I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.